this is a standard volume and deal count chart. So on the surface, it doesn't tell you much, right? But if you look at the table to the right, yes, loan volume is going down, number of deal is going down, but the key is number of deal has been going down at a faster rate than the loan volume. And what does that mean? That means the average deal size has been going up in the past 5 years. 5-year CAGR for both APAC average as well as Hong Kong market has been going up at about 2.4%. And the average deal size originally has been larger in Hong Kong than the rest of the APAC market, but it's also growing at a faster rate. So what does that mean? From a supply side, borrowers are able to take out bigger financing, right? Perhaps for bigger, capex deployment. And from demand side, lenders are flushed with liquidity. So isn't that all a good thing? Depends on who you ask, right? Because the thesis is capacity to deploy has become more important. As in, if borrowers are asking for bigger deals and your balance sheet, your single borrower limit doesn't change, it's going to be a bit harder for you to pitch for deals, right? So the market is favoring bigger lenders by its nature, but on the flip side, the banks are made to increase our deal appetite per borrower, while your balance sheet, your asset scale may not increase by the same proportion. Now, this is the number of lenders in the market. So the chart to the left is the weighted average number of lenders. You can see a trend line with it going up. It might be counterintuitive to know that there is on average 14 to 15 lenders per deal in the market. Now, this is a weighted average number, as in the larger deals, naturally with the bigger lender group, has a larger share in the statistics. So we smooth this out by looking at the number of deals, right? So the chart to the right is the deal count. So if you look at the box to the red, right, 26% in Hong Kong, that's only 1 out of 4 deals in the Hong Kong market. You see a lender group of 5 or less. And in fact, 1/3 of the deals in the Hong Kong market, you see more than 10 lenders. That's quite staggering, right? So what you see is a bit of concentration of credit appetite from our partners here, from the banks here, when the banks are crowding into the same deals. Hence, you get a little less allocation for your deals, you get a higher scale back ratio, right? Now, this is where the lenders are coming from. This is an anatomy of the league table credits in Hong Kong. So this might have left out some of the smaller participants, but it's a proxy of where the lenders are coming from in the Hong Kong market. So from the bottom, the box in red, Chinese banks, impressive book growth in the past few years. They're obviously a mainstay in the Hong Kong market, but Taiwanese banks also are getting more active, right, the past 5 years. And also another winner I want to call out is Indian banks and Middle Eastern banks. So together, they're still a small part of the market here. However, I think their share has been growing gradually, and in the next few years, we see that trend continue. So on the flip side, if you look at the American banks and the European banks, I think there's a little bit of retrenchment of credit appetite towards Chinese and Hong Kong credits, right? As you can probably tell. So you get a bit of regionalization within Asia with, the Chinese banks, Taiwanese banks, Indian banks, Southeast Asian banks looking into Asian deals, while your Western banks are using the word decoupling out of our deals here. Now, this is where the deals are coming from. This is by country of syndication. Again, starting from the bottom, Australia in blue, very impressive growth in terms of volume, not only in terms of M&A lending, but also infra lending, corporate loans, and China in red. There's been a bit of contraction in volume in the past 2 years, because of over economic weakness, right? But I just wanted to point out the winners here. One is the box in blue, which is Southeast Asia, mainly Singapore, Indonesia, Malaysia, right? A lot of flow in the past few years. The share in the market has grown from 14% to 20% in the past 5 years. And same for India market, very, very active the past 2-3 years, the box in green. Now, pricing, we don't have a systematic way of capturing loan pricing because a lot of club deals they don't disclose, but a lot of syndicated deals do have pricing data. So what we do is we take the margin, we take a weighted average of the margin, and we divide it by the tenor of the deals. As in, if it's a 100 margin deal and it's a 5-year loan, then the average margin is 20. Now, the point of this is not the accuracy, but more on the general trend line, right? So you see there is a general declining trend in the past 4 or 5 years, and more so in Hong Kong than the APEC average. Now, currency, given how high the US dollar base rate has been, it makes sense to know that the share of US dollar loans have gone down, and euro is a big beneficiary of this, but also for other local currencies, right? Sing dollar, Aussie dollar, Hong Kong dollar, Japanese yen, as well as renminbi, offshore CNH. And if you look at, in particular for CNH, right, the line in red in both charts are offshore CNH, right? And the chart to the right, which is the Hong Kong market, you could see the share of CNH volume has overtaken that of euro the first time in 2024. So just putting this together, right? So deal size has been getting bigger. Are we witnessing a Matthews effect in the bank market? As in the bigger players are getting bigger, stronger. You tend to get that when you have a bit less, a bit less differentiation of credit appetite, right? The banks are sort of crowding into the same deals. Hence, you get a higher scale back ratio. So flight to quality is one thing, but flight to the same type of credit is what's driving behind this. And also, you've got a bit of regionalization, right? So you see international borrowers tranching out their different deals into different regions. So you see they do maybe a renminbi syndication with the Chinese banks. They have a Japanese yen syndication, and then they might do a US dollar, and then there's a Middle Eastern syndication. So, sort of regionalizing their funding channels. Now, obviously, a bit of pricing compression with borrowers going from US dollar into alternative local currency as well.